So I convinced myself to make another video on this. This is still going to be about options trading. Primarily, we're going to be talking about the call options. Now, earlier when I made this video, this ask was only $2. So I'm going to pull up a chart to give you an idea of what this has been doing today. So this was where it opened up at, and this is where it's currently trading at. So, I mean, it's about $4 up right now. I mean, I've just been sitting here watching this thing just take off like a rocket. This happens to be Pixelworks Incorporated. They actually just announced that they were going to be doing some business with Apple. So let's pull up our trade tab so we can get our options chain going. And I want to explain this. So if we were to buy 100 shares right now, it would cost us about $868, and I know that's moving, so that is going to move throughout the whole video because it's still trading right now. But earlier it would have been a little bit cheaper. This may move up a little bit because the reason I wanted to give this as an example is these contracts are trading so rapidly right now. Like, I've seen this move at least 45 cents since I've looked at it. Now, the best strike price that I'm looking at right now is the 750. So what a call option basically does, it gives us the right to control 100 shares. So if we exercise it, it lets us basically buy at whatever strike price that we picked. And then we have physical stock, and as the market's trading, say it's trading over 750, which it is right now, it's trading at 879, we can then sell the shares into the market at a higher price. Basically, you'll see these quotes, and you'll notice, like, this says $2.45. This one's $1.10. This one's $4.30. And since it controls 100 shares, you have to use a 100 as a multiplier. So this suddenly goes from $2.45 to $2.45. Same thing goes for the delta and the theta. And those are the two I'm going to touch today. I'm not going to touch gamma or vega. But delta, what you primarily use this for, delta basically states per dollar movement, it's going to move 71 cents on the dollar. So since you're using a multiplier on this of 100, just think of it like $71. These contracts are going to be more valuable by $71 if it moves another dollar up from where it's currently trading at. And theta is basically time decay. So every day that the contracts don't move into the money or whatnot, every day you hang on to the contracts, they're going to lose about $2 per day. So depending on how many contracts you have, you know how much you're going to be losing. Right now, these have 43 days to expire, so you already know they're going to lose, if it trades under that, $43 all the way from now to expiration. So they have to make a significant move if you're trying to go long on your options and actually exercise them. Now, the option price itself, if you're trying to actually trade these, like I'm almost getting ready to say, maybe I didn't say it, but people trade these almost like stock. So they buy the contracts and they just sell them at a higher price. They're not using them, they're really not using them to exercise them, where they can actually own physical stock at any of these prices. They're just trading these for their bid and the ask. Now, on this one, take a look at the spread on that. Like, it's $2.45 right now, but the bid to be able to sell it is only at $2.05. To me, these are not worth trading like that because I can't get rid of them at a very decent price. Like, if it only had a penny spread, it might be worth it. These are better played, though, just for the strike price and the idea that you're going to exercise them. So it's the stock. I mean, the stock is still trading amazingly. But I mean, if this had only a penny spread, these would have massive amounts of volume because people would probably be trading these just for the premium. And then they would be looking at the delta saying, well, if it trades up $1, they're going to make $72 on the contracts. Boom, right there if it trades up $1. And if it only trades up half of that, well, then you know it's going to be half of the delta. Now, in the idea that the stock trades back $1 or even $2, contracts always lose value faster than what they gain. So if it trades back, if it trades down, usually they lose value much faster than what they would gain. So And then the idea that when it comes time for it to rebound and it comes back up, like say you have bought them and it was trading at $8. Trades down $1, they lose some value, and then it comes back up to $8 and the contracts are less valuable. And you go, why are they less valuable? Well, when it trades down, the delta changes. It becomes a smaller number. So then when it gets ready to trade back up, that smaller number still sticks with it. So like if it was 70 when you first got them, and then it only turned into like 30 by the time it traded down. So then it would only trade $30 on the dollar. You're still stuck with only that type of movement, if you basically understand what I'm saying. So that changing of the delta is important. And at times when you have something trade against you like that, it's almost better to just, cut your losses instead of trying to make back what delta has lost and the contracts have lost. Because usually to get back to point A again where you're at break even, it's going to have to trade over what you originally bought in at. So, and that's just if you're trying to plan for the premium. If you buy an options contract in the idea that you're going to exercise it firstly, then you understand, say, if the contracts lose value, maybe they go all the way to zero. In 43 days, they lose $1 a day, so they're already going to be $43 less valuable. Maybe even delta goes, it's just slow and nothing really happens, but it trades like 50 cents over what you bought them at. You can still exercise these. So maybe if your premium is not worth that much and you'd make more money exercising the options, you can do so. I mean, let's pull up an Analyze tab to give you an idea of what I'm talking about. So right now, for break even, we're looking at trading at $8.88. So our break even, this just recalculated, is $9.73 or 78 cents right there it's saying. So that's why you have this break even line and then your equity. Every time you exercise these, that's another thing. This premium that you put up to buy them, and I'm going to go ahead and maybe unlock this. There we go. So you're basically putting that up, and that's what you have to be willing to also sacrifice if you exercise them. So on this trade, you put up $245 to reserve a price, and you exercise it. It takes that $245 and you make whatever gain it did from this break-even point. So $9.95 is what we're currently looking at for break-even, and that seems about accurate to me after looking at the price changing at $8.81, $8.89. It's really changing rapidly. But and then to get to $100, that's this first line right here. So we'd be looking at about $10.90, and etc. And an easy way to look at it is, this can right now one contract controls 100 shares. So if you own the stock and it traded $2 up, you'd make $200. So if it trades $2.50 up, it's going to make $2 or $250. Think of that in the idea when you're also getting ready to exercise it too, because look at it right now. We're putting out $245 worth of premium for that. So we got to make that back. So that's how you could put that together with that. If hopefully I'm not losing you on this. But in the event that any one of these trades goes against you, like we buying right now, I'm going to go ahead and hit the lock on this. And basically we are at risk now, $245. So if it trades against us, time decay hits it or whatnot, maybe the stock just trades down, we need to be willing to lose that $245. The advantage of doing this, though, and sometimes you can get an option at a better price when it's trading more. The stock price is trading at the money of what you're trying to capture. You pay a lot less a premium, so there's a lot less going on the table right now. This just happens to be expensive. Earlier today when I was looking at it, it was about $160, and now it's $245. You put a specific amount of money on the table for risk. So if it goes against you, you lose your premium. Now, earlier today, that would have only been $160. So if I own the stock, that means it would have had to trade about $1.50 against me just to take that amount of money. Now with an option, it could trade all the way to zero. If you put out 160 or this 245 worth of premium, it trades to zero. You're only going to lose the $245. That's the nice thing about it. Now, people trade with a stop though on stocks, so it is arguable that you could be better off just buying the stock. But that's something you really have to plan yourself to figure out what position is really worth more doing. Usually, if you're speculating and you want to get in on something, you think it's going to do good like this. This particular company has announced, they're going to be doing business with Apple, and you want to get in on the movement. And you're afraid to buy the stock because maybe this is just kind of a pump up thing, and then maybe it's going to dump off or whatnot, and you don't know, or maybe you haven't done enough research on the company you're looking at, which I always think you should do your research as much as you can. This is a cheaper way to do it, and you have a specified loss. So that pretty much wraps up today's video on options trading. I will cover some of the other things in the future, like the put contracts and all the other Greeks. But for now, this is a pretty good video for starters. So thank you for watching.